I think the first general point, Paul, is that CEOs will need to be aware how different is the picture in different regions of the world as the economies begin to pick up after the recession. So you've got, for example, in Europe, quite a lot of gloom around some of the weaknesses within Spain, within Greece, within Italy, coming now to be of concern to bankers. You've got the emerging economies of South America beginning to look much more attractive, Brazil in particular, and their emergence from the recession is a standout. You've got the commodity-based economies of Australia, Russia, now doing better as China's economy picks up and the big demand for commodities improves. So you've got some clear indicators that certain economies are likely to do better than others or emerge faster from the recession. And of course you've got the big player, China, recording some impressive GDP growth and the benefits of a system of capitalism that can build you 30 international airports in 1 year, while Mayor Richard Daley is still waiting in Chicago to put another runway into her hair after 6 years, shows perhaps part of the paralysis of the democratic systems that then of the Western world, here in the States, in certain parts of Europe, real concerns that the issues that decision makers have to grapple with to get their economies back on their feet and get them growing are politically too difficult to achieve. And I think it's that political dimension which the CEOs need to think about. It's the basis on which the economies are emerging at different speeds from the recession, and it's the very uneven spread of the recovery across the globe that needs to be watched very carefully. One of the big aspects is about confidence and sentiment, and I think the CEOs gauging the barometer of confidence across the world is always difficult. But certainly the Greek experience has shaken confidence in the strength of the Eurozone, has encouraged speculators to speculate against the euro, has, I think, perhaps knock-on effects to confidence elsewhere in the world in the financial systems and the default possibilities of countries, not just the default possibilities of financial institutions. Secondly, you've got, I think, the very real issues around increasing capital adequacy ratios for banks and the pressure being put on banks, not just about bonuses, but about really how they're structured and therefore their ability to rebuild their balance sheets so they can lend money. And the big issues around, well, who has got money to lend? Where does the equity come from? Dubai, no longer in favour as a source of wealth. There are some sovereign wealth funds out there that do have money. There are some big institutions now diversifying their portfolios back into commercial property. There is the fact that there are not many attractive options to commercial property. Interest rates low, a range of other commodity-based investments perhaps not looking too attractive to some investors, and in building a portfolio of investments, I think it's fair to say that many institutions are now looking very closely at increasing their commercial property holdings, again, provided they can find the right property in the right place at the right price with the right risk